Today, I'd like to show you why value add is my favorite way to invest in today's market. Let's jump into it. My name is Luke Smith, and today I'm talking about Raisin Canes. So I'm on Crexy.com, and I was looking at retail properties that are for sale in the state of Kentucky. And so the one that comes up at the top of the list is, I was just going, I like going through every one of these properties, looking at them, asking questions, and learning from them. Not that I'm going to buy them, or work on them, but learn from them so I can understand what's happening in today's market to use that on future deals, other deals that I get into, and have a better perspective of what's going on and what tools I could use to improve properties going forward, right? And so this is a learning curve for me. It's a learning curve. Maybe I can share some with you too. So Raising Cane's is the top of the list. This is the newest listed thing in the retail space, or QSR, quick service restaurant space, on Crexy in the state of Kentucky. This has been on the market for 6 days when I'm filming this. It's a Raising Cane's. And at first I was looking at it and like, the kind of curvature of the roof here maybe looks like an old Hardee's or something. It was this really, and it doesn't look like the modern Raising Canes that are hitting the markets all over the place. So I was thinking maybe possibly Raising Canes converted an old QSR into a Raising Canes, when generally I just see Raising Canes bulldozing everything and building a new one. Raising Canes can do that because they've got an awesome average unit sales. Average unit sales is how much they're selling per restaurant. And so if we study how much Raising Cane's is selling per restaurant compared to lots of other restaurants like a McDonald's or something, Raising Cane's is kicking butt. Their internal or the sales per location has just been going up, 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 up. They've got a menu where they just focus in on a couple things that sell really well and they stop messing around with the rest of the stuff. They just go all in on what does really well and they're hitting it out of the park. They're adding locations like crazy. They're looking for a lot more locations. They recently did a big, pay off a bunch of debt, recapitalize to take on even more locations. They're going as fast as they can. They want like, I think they're opening 100 locations a year. They want to do like 300 a year, some kinds of numbers like that. And when you have sales like Raising Cane's on a location, you can outbid everybody else, except for maybe Chick-fil-A or something, right? But almost everybody else. And you're right up there and you're killing it. They're doing almost $6 million of sales per location. 5.5, 5.4, 5.6, something like that. But the way they're going, it's probably $6 million per sales per location in 2024. And so as a landowner, I would love to have a piece of land and get Raising Cane's to build on it and go make it happen. And so when you look at a location like this, what does it take to make Raising Cane's? What's the traffic? What's the demographics? Who are the neighbors? Why this location over all the others? Of course, there wasn't a Raising Cane's here down the street or something before, but there's a whole bunch of towns in the U.S. that have these kinds of traffic and demographics and economics of people and stuff that don't have a Raising Cane's yet. And there's locations in those towns that we could be working on and pitching to Raising Cane's. So the more I know about those, the better I could understand that when I come across those locations in the future, and that's part of what I'm studying. So looking at this thing, I like going into Street View. Excuse me. We'll just bounce over to Google Street View so we can get like historical kinds of. And so I'm thinking, yeah, maybe they were something else before. And so I just started going back in time and looking at them. And it's Raising Cane's, Raising Cane's, Raising Cane's. I did some more studying, and it's been a Raising Cane's ever since it was this building. But here we go. It goes 2012, between 2012 and 2014. It's something else. This is like an old medical building. I was looking at the signs, and I think it says care center or some kind of medical, ugly old retail building that's not trying to face the street. Their windows are like off to the side, not trying to sell people on the street. They're trying to make it nice inside, but they got a busy street out front. And they were advertising back in the day, for sale, lease, build to suit. What can we do to get you in here? Look at the traffic on this thing. There's a bunch of nice traffic going by. We got a Taco Bell across the street. I think it's a Kroger, and I mean, this one over here looks like this one was getting reworked back in the day too. If we go to modern times, we'll see what it turned into. It just turned into uh, hospital something, like medical care. Um, but so how did somebody go from this old ugly retail building to one heck of a Canes? Now, looking at the price of this thing, like they're asking on this particular Raising Canes, they are asking $4.875 million. And that's like, they say it's a 6.4 cap in the listing. And I'm like, 6.4 cap for Raising Canes? Raising Canes is usually in the fours. Like those guys are selling, they've got a great credit rating. People believe in them up to the moon and buy the heck out of those things. So with four cap is a higher price than a six cap because like just the way the math works, right? The cap rate is the kind of yield you get over the price, of how much rent you get over the price. And so this particular location is behind my head here. It's kind of small on the screen, but they're getting $312,000 a year in income or rent from this property, and the tenant pays for everything else above and beyond that. It's just triple net. So if you owned it, you'd get $312,000 a year in rent, and you put that over the price that they're asking, and that is 6.4 cap. But if the price was a lot higher, it could be a 4 point something cap like the market is. And so I looked, just a guide. This isn't the end all be all of pricing or anything. But I looked on Net Lease Advisor, and sure enough, I thought I remembered it, right? It was like in the fours. So this is updated April of 2024, so maybe it's not dead accurate, but like they're basing it off of three trades down here, and you can go see what the three trades were, but a 4.43 cap. And so let's say we were crazy enough to buy this thing at the 6.4 cap that they're asking, and then we turned around and marketed it for like more like what the market is, four. So if we have this rent, $312,000. Let's see if I can make this bigger. Nah, it doesn't make the numbers bigger. So if we have $312,000 rent divided by 0.044, what was that? 443, 443 cap, like the guide thinks the market is, it's going to be more, right? It's going to be $7 million. So if we had that minus what they're asking on this property, there's a lot of money there. That minus 4,875, just over $2 million, $2.1 million. There's a big spread just by having the cap a little off. Okay, this building's a little bit older. It's in Kentucky, whereas the other examples were California. I'm sure there's differentials in there, but there's still a lot of room for error. So one way of adding value in these kinds of properties is just to buy it at the right price and sell it at more like the market. That's the simplest, easiest, fastest, most creative way, right? Another way to add value on a property like this was buy it when it was the old ugly building. Where'd the old ugly building go? Here we go. The old ugly building. And go call Raising Canes and all the developers for Raising Canes and say, hey, guys, I'd like to turn this into Raising Canes. I want you to do it. Here's the property here. Let's go for it. And so what happens if you do that? I looked up the transactional history of this particular property. And so somebody bought this property, the old ugly building, in 2008, like July of 2008. I bet you they wish they didn't buy it for a couple of years after that. It was $895,000 they bought it for, and they got 11% down payment. They basically put down $100,000, and I mean, they bought that thing, and then they went through the real estate crash, and then eventually they sold it for $1.3 million in 2014 to somebody that's got Canes in the name, so they're probably a developer for Raising Canes, and those are probably the people that made it into a Raising Canes. So the Raising Canes developer bought it for $1.3 million in February of 2014. And then they did a loan. So the developers did a mortgage for $10 million Buy the property for 1.3 million, old ugly retail, and then get a loan from the bank for 10 million bucks and go bulldoze that thing and build a Raising Cane's. Like, I don't know what that banker was thinking. They're probably got frustrated later on because then they did a short sale. The banker took it in the shorts, right? That's what a short sale is. And they, so a new company came in and bought it for 3.6 million, got 80% financing. This was 2016. And then looking at the history of the property, I mean, looking at the what these guys looking at the listing and stuff, it looks like the franchisee that built the thing, they went belly up. And Raising Cane's corporate came in and took over the location and ran with it from there. So it might have gone from franchisee credit rating to corporate credit rating, or maybe corporate guaranteed it out of the gate and franchisee just folded and left. But either way, Raising Cane's corporate's running it now. And now you've got this awesome rent flowing out of this thing, and you could sell it for a bunch of money. If you went up towards market rates, I mean, it could be maybe $2 million higher than what they're asking on the marketplace. Maybe I'm missing a part of this equation, but I thought that's an interesting deal. I'm not financially ready to take on a trade like that, but maybe some of you guys are. And I just learned from looking at each one of these trades. So pointing it out, showing, sharing. I pulled up Raising Cane's and a whole bunch of other listings on the market. And I mean, these prices aren't out to lunch. Like a $7 million Raising Cane's, there's an 8 million over here, and a 5, and a 3, and a 10, and a 4. Well, the 4 over here is the one that we're asking, but a lot of these are asking 4.65 cap, 4.25 cap, 4.4. Here's one that's 5.5 cap. So here's one in Ohio. Let's pick on this one. 5.5 cap rate, which is more expensive than the one we were just looking at. $5 million asking price. They've got a $269,000 rent, $269,000, 10 years left on the term. And the one that I was just showing you has $312,000 with 9.4 years on the term. Why such big price differences? So I just like looking at these, tearing them apart in different ways, comparing notes, comparing numbers, and seeing where I can find opportunities. So, and I'm going to try to share. And if you guys have questions, comments, please throw them in the comments below. And thanks for listening. Thanks for watching. See you in the next one.